Hello and welcome to another portfolio analysis video. And today we're doing probably the most requested one, which is Warren Buffett. And this is going to be a little bit different than the other videos in that I'll be explaining a little bit more about Berkshire Hathaway's business model and just why Warren Buffett has been able to be so successful. So, without further ado, let's get into it. So, when I say Warren Buffett's portfolio, it is Berkshire Hathaway. That is the entire thing. So, I guess you could say he has 100% of his holdings in one company, but that doesn't exactly tell the whole story. Now, you can really think of Berkshire in 5 parts, and I explained this a little bit in the Bill Gates video, but I'll go over it again here. So, you have the wholly owned insurance subsidiaries of Berkshire Hathaway. So that's Geico, that's General Re, Berkshire Reinsurance, National Indemnity, and insurance, as I'll explain later on, is really the bread and butter of Berkshire's business. On top of that, you have the wholly owned non-insurance subsidiaries, so ones that Berkshire owns outright. So, you've got your Dairy Queen, you've got Burlington Northern Santa Fe, the railway, Duracell, Fruit of the Loom, NetJets, and See's Candies, which is one of Buffett's best investments, to be honest. Then you have businesses where Berkshire owns a significant stake in, and, to the point where they have control. So you've got Kraft Heinz, probably the most well-known of those. Pilot Flying J, which is the chain of gas stations. And then you have the other part of the portfolio, which is their stakes in public companies. So they're ones they do not have a controlling stake in, but ones where they have a significant stake in. So that is your American Express, Apple, Bank of America, Coca-Cola, Wells Fargo. And so that's the more widely known part of Berkshire's investments, because that's the part that gets all the publicity. Whenever you see Warren Buffett just bought this company, or Warren Buffett just bought a stake in this company, that's what it means. And then on top of that, you have the cash position, which in itself is significant, 137 billion. That was at the end of the first quarter. I believe it's a little bit less now because they made some purchases in the second quarter, which I'll be talking about later on. But it's significant, and I'll explain why in a little bit. But first we have here just a little screenshot of the wholly owned companies of Berkshire. So you've got Burlington Northern, Dairy Queen, See's Candies, NetJets, Geico, Mid-American Energy, General Re, and a few other companies there. So why insurance? Why does insurance make up such a big part of Berkshire's portfolio? And how have they leveraged the insurance industry so well over the past 50 years? Now, a lot of people don't really understand how the insurance industry works. Or, more importantly, they don't understand how valuable the insurance industry can be to a wider portfolio. Now, let's just look at this little snippet here. On February 22nd, 2019, it will be 52 years to the day since Warren Buffett took his first serious dive into the insurance business, when Berkshire Hathaway entered into an agreement to acquire National Indemnity Company and another smaller insurer for $8.6 million. 52 years later, it is still part of the portfolio, and Buffett said in 2004, if Berkshire hadn't acquired National Indemnity, Berkshire would be lucky to be worth half of what it is today. So here's just why the insurance industry is so lucrative and why people like Buffett love it so much. Now, there's two ways the insurance industry makes money. The first, and this is the one that most people assume is the only way, is you take more in premiums than you do, and then you pay out in claims. So, I mean, it's the whole point of having insurance. You hope you won't have to use it. So, you have your home insurance for 40 years, and nothing bad ever happens to your home. And that's great. That's win-win. I mean, you hope that nothing bad would ever happen. And so, you pay the insurance company, and they don't have to pay out anything in claims. And if they take in more than they pay out, they have what is known as an underwriting profit. That's great. But here is where the insurance industry really excels, and this is the concept known as float. Because most insurance it's a long-term investment. You're not taking out insurance with the plan that you're going to have to use it within 3 months. And in fact, most of the time you hope you will never have to use it. And this is particularly the case in areas like disaster insurance, for example. Things like hurricanes, floods. You hope that you'll never have to cash that in. So the insurance company will get to keep your money forever. And insurance companies know this. And they know that there is, if they're well run, of course, they know that they have a certain percentage of that money they take in as premiums to reinvest. And this is what is known as the float. Most insurance companies, they have very low risk investments with their float. So they'll buy treasury bills, for example. They'll get a couple of percent and they'll sort of see it like interest. Berkshire, on the other hand, and they've done this masterfully for over 50 years now, they will buy public securities with the float. They'll buy companies on the stock market. In fact, they've used their float to buy entire companies. And so that is really why Berkshire has been able to be so successful, because they buy well-run insurance companies and then they invest the float in things that will make them more money. And I believe Berkshire has about $115 billion worth of float currently, which is $115 worth of insurance premiums that have not been paid out as claims. And they can invest that money how they see fit. So essentially they're playing with house money. And if you're wondering why don't all insurance companies do this? And there are some others that do. There's one called Markel, which we recommended inside 20 for 20, 8-Step Beginner's Guide to Value Investing. They've been called the Baby Berkshire, in that they operate a similar business model to Berkshire Hathaway. But it all comes down to management. And it all comes down to how well can the person in charge manage the combination of maintaining underwriting profits while investing the float in an intelligent manner. And Buffett himself did this for many years, and now a guy called Ajit Jain oversees Berkshire's insurance business. And if you read a book called The University of Berkshire Hathaway, which is a pretty good read, it's essentially a summary of the last 30 years of Berkshire Hathaway shareholders meetings. In the past, it goes up to 2014, I believe. And I believe in the final 10 years of the summary, so from about 2005 to 2014, every single one involves Warren Buffett layering praise on Ajit Jain and his ability to manage Berkshire's float. And that really has been a key driver of Berkshire's business within the past 10 to 15 years. If you look at this chart here, and I apologize for the overlays here, I took this from gurufocus.com. And here it just shows the last 20 years of Berkshire and the balance between their fixed income, so bond investments, their cash, and then their equity investments, so their stock investments. And if you just look at the divergence from 2013 onwards, how cash has become such a significant part of the business now. And, you know, Berkshire's cash holdings alone would be an S&P 500 company, which is astounding. It's cash. I mean, this is frankly insane, and this is just why Berkshire has been able to perform so well in the past 6-7 years, because of this float and because of this reinvestment. And if you look here, the equity performance itself was fantastic the past 4 years. So now let's look at the equity performance. Let's look at the companies they own a stake in. So this is really why the float matters, because Buffett can be more active in down markets. So if you listen to any interviews with Warren Buffett from 2018, 2019, he'll tell you that, you know, they haven't been very active lately because, frankly, a lot of things were massively overvalued, so they didn't see any point. And when you have such a big float and such a big cash position, you can afford to be patient. And this is why this quote gets trotted out a lot. Bad news is an investor's best friend. It lets you buy a slice of America's future at a markdown price. And this was key because in the financial crisis, Berkshire bought stakes in Mars, Goldman Sachs, Bank of America, Dow Chemical, when all of these stocks had been heavily beaten down. And then within 3 years, the stakes were up $10 billion, which was about 100% increase from the money they invested. So that just goes to show, if you have cash and you can be more active in the market, you can afford to wait for these opportunities. And just speaking for myself and my own investments, I believe March this year, which was when the big 30% dip happened, was my most active month ever in terms of me buying stocks, just because there were so many companies that either I already had a position in or I'd wanted to take a position in that now were at very attractive valuations. So that just goes to show, like, it's always important to have cash on hand so you can take advantage of opportunities like this. And this is why I don't understand the CNBC line that they keep trotting out, which is you always need to be fully invested. But it's like, if you're already fully invested, there's no cash. So why would you always be fully invested? And that's why I very strongly believe, and Warren Buffett will say this as well, you should always have a cash position to take advantage of opportunities that emerge. So this is Berkshire's stock holdings. And as you can see here, a lot of people don't realize this, that Apple makes up almost half of their portfolio. And their stake in Apple would actually be, I think it was, I was reading this the other day, the 50th largest company in the world. That would just be Berkshire's stake in Apple. So that's pretty insane. It's worth $89 billion. So that's a significant stake, and it's a real ride your winners kind of deal, because Apple has been such a strong performer over the past 5 years that they've just kept adding to their stake. And people gave Buffett a lot of flack because they think he's this Luddite who hates technology. And they were saying, he got into Apple far too late when he first bought them in 2011. But since 2011, Apple has been through the roof. So I don't think it's a case of, he missed the boat on Apple. It's a case of he only invested when he felt like he understood the company well. And the difference between Apple in 2020 and Apple in 2011 is a big difference. And the difference between Apple in 2011 and Apple in, say, 2003 is a massive difference. So that's something that a lot of people, I think, cost themselves with, is needing to be the earliest and needing to be first. And if they feel like they've missed the boat, then they never invest anyway. You know, you could have bought Apple 6 months ago and your position would have increased significantly. Same with Amazon. Very mature companies, but still had a lot of room to grow. And, you know, we've seen that the last 6 months with Apple and Amazon particularly. Some of the other positions, you know, the Coca-Cola one is famous now. 400 million shares. And that's just something that is a bread and butter of Buffett's business philosophy, is buying companies with business models that last, with great management teams. And, you know, we recommended Coca-Cola in the 8-Step Beginner's Guide to Value Investing. I still think it's a great company. I think it's one that will be around for a long, long time. Moody's is another interesting one. And Moody's was one that Buffett took out a stake in after the financial crisis, when any sort of financial services company and credit company like Moody's was heavily beaten down, and Moody's has been a strong performer for him ever since. And it's another one, sort of like the insurance industry, where it has a very profitable business model. Moody's has incredibly high margins, and it's one that can just chug along in your portfolio and keep bringing in the gains. The two, Bank of America and American Express, beaten down this year. I don't love the Bank of America position. I'm not a big banks guy. And also I think there's more opportunities in these smaller regional banks than there are in the giant ones. So same sort of goes with the Wells Fargo and the US Bank Corp. Big businesses, currently extremely exposed to the financial uncertainty, and I'm not sure if their business looks the same in 10 years. And I mean that in a negative way. I don't know if they will be able to keep up with even the market average over the next 10 years. I certainly don't believe they'll outperform it. So, but this is Buffett's bread and butter. He's loved banks for a long time. So I think he's sticking to what he knows in that sense. Couple of other interesting things. He took out a small position in Amazon, and a couple of these defensive picks, like Costco and Kroger, they should perform well over the next 5 years. We recommended Walmart, which is another similar style defensive stock, relatively recession-proof. But I like Walmart's management team better than Costco's and Kroger's, so that's why we went that direction. Owns both Visa and MasterCard. Once again, you can see what kind of businesses he likes. he likes these financial services companies. He likes companies that don't necessarily have giant overheads and huge manufacturing costs. We'll just have to wait and see, really, whether these companies will be able to stay strong over the next 5-6 years in the current uncertain market environment. But to be frank, if you look at the weighting of this portfolio, if Apple performs well, it's going to just lift everything else up. So that the real lesson here is ride your winners. If you have a winning position, don't be afraid to add to it. And we talked about the bad diversification strategies in the 8-Step Beginner's Guide to Value Investing. And this is an example of, solid diversification, because he hasn't been afraid to let his winners ride. And, the portfolio has done well because of that. Couple of other updates to this. So, as you can see, there weren't any airlines in that image because Buffett sold his airline stakes at the beginning of the year. And he admitted that it was a bad move. And even at the time, I was a bit confused by it because he was so against the airline industry for so long. Because, as I mentioned previously, it's a hugely capital-intensive industry. Those planes cost a lot of money. And it costs money to send them across the country half empty, as it does if they're full. And so, especially American, Delta, and United, they're going to struggle a lot over the next few years. Southwest, I have more faith in. I don't own any positions in any of these, but I have more faith in Southwest than the rest of them, purely because Southwest is more domestic focused and not as reliant on business travel as the other three are. Because I think domestic business travel within the United States is completely changed forever now. There will be a lot more Zoom meetings going forward than there will flying from, Cincinnati to Dallas, for example. And that really hits the Americans, the Uniteds, the Deltas of the world. He sold a lot of stakes in US banks. So he kept his Wells Fargo position and his Bank of America position. A couple of other things. He bought Dominion Energy's natural gas assets because natural gas has been heavily beaten down this year. He also took out a position in Barrick Gold, which is the largest gold mining company. This was reported as Buffett buys gold, but he didn't buy physical gold. He bought a stake in a miner. And Barrick Gold, out of all the miners, as we've discussed before, not a huge fan of mining as an industry, just because I think there's better ways to profit from precious metals. But Barrick Gold, very well-run company. Out of all the miners, it's probably the strongest one. It's also the biggest, so if you look at it from that way, there's less upside. But, it's a solid, well-run company. And he also bought a lot of Japanese companies. He bought stakes in 5 different ones. And that's just another classic Buffett move where he sees American securities as being overvalued, sees Japanese securities as being undervalued. So he took out stakes in a few companies there. None of them particularly well known. Mitsubishi was one of them, but it's not the auto manufacturer. There are 2 different Mitsubishi corporations in Japan, and Buffett bought the other one, which has a pretty varied business. They have some mining things going on, they have some manufacturing stuff going on, but it is not the auto manufacturer. So just to clear that up. And that's about it. That's Buffett's portfolio analyzed. So I hope you enjoyed this video. And I know a lot of people really enjoy these videos. So if you do have others that you'd like to see, please just leave a comment down below or in the Facebook group. And thank you for watching.